the backdrop of that,
Good
right?
morning.
I mean, trading debuts don't seem to be seeing the same frenzied one-day pop. Parts of this A-share market specifically look kind of weak. I know you're still overweight. Tell us why you're not worried.
Yeah, okay. I think the recent market volatility it has been driven by concern about policy tightening risk, and investor starts to get worried about liquidity conditions in the China market. We think the PBOC is in no hurry to tighten policy because in China, the economic recovery still remains uneven. So as the China NPC revealed, that the policy stance still remain largely growth supportive. So we think the latest market pullback is more driven by technical reasons, coupled with the profit-taking pressure, investor concerns about policy tightening. But we think there would be no genuine risk of interest rate hike in China, as indicated by policymakers. I think the policy environment would stay largely stable, but the growth recovery remain pretty solid. So we are looking for 8.5% GDP growth in China for 2021, and this is going to support quite a strong earnings recovery. And we expect earnings growth to reach around 20%. And this is going to be a fundamental support for a rebound in the market, in our opinion.
And what's the play then? Is it buying the equity index? Is it a specific part of the equity, like a specific sector, for example? Or do you even look at credit, for example?
I think investors need to focus on the selective resilient areas and the bright spots that will benefit from the 14th Five-Year Plan. We continue to favor the structural growth leaders as well as beneficiary of the cyclical recovery. So the recent sell-off in Chinese digital economy stock actually create good buying opportunities, especially many of these industry leaders are strong cash flow, high ROE companies, and with strong competitive position in the digital economy. So we would take the recent pullback as a buying opportunities. And on the other hand, selective cyclical value stock also look interesting, including the Chinese banking stock, which deliver pretty compelling dividend yield. And we also expect the cyclical recovery would benefit materials and industrial stock in China. So we adopt a balanced sector strategy, both focusing on the digital economy leaders, and we also like the undervalued cyclical stock.
Fan, when does that cyclical recovery and that opportunity start to fade then? How wide is that window for investors to continue to add in that space?
Yeah, we focus on the fundamental quality and valuations. So looking at the cyclical stock in China, I think currently the valuation continue to lag behind the global and regional peers. And with the pretty strong manufacturing recovery we have seen, especially with the pretty robust export performance. So this is going to support the industrial profit to stay pretty strong, and this is going to provide the value support for the cyclical sector. So from valuations point of view, we still see the Chinese cyclical stock as quite compellingly priced, and there are buying opportunities.
How should your clients, the high net worth individuals that you work with, how should they be thinking about the geopolitical risks? We're seeing this play out now, of course, with Xinjiang. Longer term, how should they be thinking about positioning in the Chinese market?
Yeah, I think the geopolitical uncertainty will continue to weigh on investor sentiment in the near term. But looking at the medium-term investment return, I think the key focus of our clients, and this is also embedded in our investment strategy, we look at the profitability and the ROE of the underlying securities. So we assess their medium-term growth outlook, and even with the external headwinds from geopolitics, with the 14th Five-Year Plan, continue to attach strong pivot to the domestic consumption sector. And we expect the technological innovation and massive investment in the digital infrastructure upgrade would create pretty attractive growth opportunities in the domestic-driven digital economy. So there still are plenty of investment opportunities in the domestic phasing sector, and they should stay relatively resilient from the geopolitical headwinds.